This is Darren Carlett with the Bull Strangle newsletter and SpreadEdge Capital. This is a performance review for the trades that closed this past Friday. This is a brief overview of the strategy. As an introduction, this strategy entails buying a stock and selling both a covered call and a cash secured put, or what some call a naked put, both of which are out of the money. The goal is to earn option premium while maintaining controlled stock risk. Here you see kind of how the trade is constructed. You can see that we're buying stock in 100 share increments, and then we are selling a call above and a put below. The range in between is kind of a style thing. People may want to keep this tight, which gets you more option premium, or you get a little looser and have the opportunity for more stock upside. The strategy combines three strategies into one single position. Obviously, the long stock, which allows you to participate in price increases. You have the covered call, which limits upside potential in exchange for receiving premium. And then you have the naked put, which generates income while creating an obligation to purchase additional shares. Now, I have 5 videos on YouTube that describe this strategy in more detail. The first one is a little less than 10 minutes, and it provides a pretty high-level overview of the strategy. And then there is a 4-video series that covers all the topics below. In total, these videos are a little less than 4 hours of content and thoroughly explains the strategy. So it starts off with an overview of stock options. It goes through then in video 2, the strategy. Video 3 is about the risk optimization elements of the strategy. And the 4th video describes the contents of the newsletter, which is published each week. You can find these videos on YouTube and search for SpreadEdge Capital. This provides a high-level overview of the core elements. Obviously, the most important part of the strategy is to pick quality stocks. And we're looking for stocks that are technically strong, using time-tested stock engine and a variety of different parameters that help us to get to stocks that are great candidates for covered call and naked put writing. We are sellers of option premium, which does give you the obligation to sell your stock at a set price and the obligation to buy additional shares at a set price. We talked a little bit about how the trades are constructed on the previous slide, but bottom line is we're buying shares in 100 or stock in 100 share increments and selling a call above and a put below. We're leveraging a weekly option cycle where we are on Monday placing trades that will expire 4 Fridays later. We are looking at the market environment and trying to be heavily invested during what we call green episodes, or times when the market is strong, and we are going to back off when the market isn't as strong. And we are very focused on diversification across sectors, across stock price, and across implied volatility. So that's a real quick overview of the strategy. As mentioned, you can go to my YouTube channel, SpreadEdge Capital, to get a lot more detail on the elements of the strategy. This past week, the S&P rose another 1.2% for the week and closed at yet another record high. You know the old saying that a rising tide floats all boats. So, of course, in a market this strong, our strategy is doing incredibly well. But as I go through this, note that I am constantly comparing the stocks that I pick for the watch list to the S&P. So, and what I'm looking for is an outperformance of the S&P. And I think, as you'll see, the watch list has been really smashing the S&P pretty much every week. This slide illustrates how the option premium impacts the total profit. This analysis includes 367 trades from February 2024 through August 29th. The data set is sorted high to low by stock gain percentage and then is divided into 20 equal buckets. On the left compares the stock gain to the trade gain, and recall that the trade gain includes the stock plus the options. And on the right is the same data, except it's in table form. Note that when you break this down into the different buckets, the first 5 blocks represents where the stock gains are capped by the covered calls. This is 25% of the time, and you can see that once again, you can't go above once you reach that call strike price, your gains are then capped. So in this case, the stock gains were quite a bit higher than the options. The next block, which includes 6 through 11, is where the stock gains are amplified by the call and put premiums. And in each of these blocks, we see that the stock and options is higher. And of course, the same is true for blocks 12 through 15. But in this case, we actually took and turned a stock loss into a trade gain. And then the next block is where the stock lost and the trade lost, but the loss is reduced by the option premium. And then the very last block, which is 19 and 20, this is where the naked puts actually worsen the trade losses. Now, this last area is, of course, the worst case scenario, but note that occurs about 10% of the time. Now, looking at this at a little bit higher level, we see that 25% of the time the stock gains are capped by the covered call. We see that 65% of the time the option premiums improve the overall performance, and then just 10% of the time the naked puts actually worsen the trade losses. All right, when we start talking about the different variations, I think that I tried to design this in a way that really simplifies thinking about all the different components of these different variations. Bottom line is you can trade up to 8 different strategies, which accommodates a very wide range of risk profiles. So there's really 4 strategies, but you can also add protective puts to any one of them, which then doubles it to 8. Now, the way I like to think about this is that there's really just 5 different components that are used throughout any of the strategies, right? The first is buying stock in 100-share increments, and then there is selling a call above the strike, there's selling a put below the strike, there's buying a put below the sold put, which turns that naked put into a put credit spread. And then there is buying a SPY, which is a S&P 500 or a QQQ protective put, which kind of protects the broader portfolio, not an individual stock. Now, as you go through this, these components are the same no matter what your strategy is. So for example, every strategy includes the green block, which is the stock, okay? And then the others become a little bit interchangeable, right? So a covered call naked put would include the green, blue, and yellow blocks, and so on. And you can see how you just add these different components to change the strategy up. This building block concept is covered in detail in the videos, but for the purposes of this review, I want to kind of give you a very high-level overview. Bottom line is I'm tracking a number of different variations so that people can, alter the strategy to fit their risk tolerance profile. But when I'm reviewing the performance, I'm only going to focus on the core strategy, which is listed here as the number 1. It's the covered call naked put. And as I've already mentioned, it involves what I'm the green building block, which is the stock, the blue building block, which is the call sold above, and the yellow building block, which is the put that is sold below. Okay, let's start the open trade summary by looking at the trades that will expire this next Friday on September the 26th. For this cycle, we had 22 trades. 18 of them are currently up, and that is beating the stock win rate. So the calls and put premium is adding to the gains, bringing a stock gain of 68% up to 82%. The average stock gain is 10.6%, which is incredible, and over 3 times the 3.2% gain of the S&P 500. And the average trade gain is at 8.6%. So it's lower than the stock gain, which of course means that we are capping our gains. Next up is the stocks that are going to expire, or the trades that are going to expire on October the 3rd, which would be 2 Fridays from now. For this watch list, we had 20 trades, and 17 of them are currently up, compared to a 65% win rate for just the stocks. The average gain for the stocks is 7.9% compared to 2.8% on the S&P. So, we are in a very bullish market, obviously with the S&P increasing this much, but the important thing, and the thing that I keep focusing on, is the fact that our stocks are steadily and consistently outperforming the S&P. And then our average trade gain is at 7.1% for this week. So this is shaping up to be a pretty strong week, and hopefully we can maintain these gains through expiration. Then finally, we have our trades that are going to expire on 10/10. That's going to be 3 Fridays from now. And these were the ones that were just opened this last Monday. For this watch list, we had 22 trades, and 21 of them are currently up, which is obviously very strong. And our average trade gain, again, this is just for 1 week, is 6.8% compared to the 1.2% that we saw for the S&P 500. So, we are very near 5x the S&P for this cycle. And then the average trade gain is at 7.7%. So you'll notice that we are capping our gains in 2 of the 3 weeks. So one might wonder, why do we even sell the options? And the reason is that over time, and I always like to think of things in terms of 1,000,000 trades or 1,000,000 weeks or 1,000,000 cycles in this case, we're not going to see a market that's absolutely this strong. So going back to some facts that I went through earlier, we are going to, the option premiums we're selling will enhance our returns over time. We are in a very strong market, so that's not happening consistently, but not to worry. When our trades close above the call, we are maxing out that trade gain, and of course that's a good thing. Now, sometimes we're not getting as much as we would have, but we're still winning. Okay, that completes kind of the open trade summary. The rest of this presentation is going to be on closed trades. Okay, here is the performance of the trades that expired this past Friday, the 19th. For this watch list, we had 20 trades. The trade win rate was 19 out of 20. We had just 1 loser for the entire 4-week cycle. And 16 of the 20 stocks closed higher over this period of time. So our average stock gain was 10.4% compared to the S&P at 3.1. So we were more than 3x the S&P, and our average trade gain was 8.9%. And I'll just tell you, in my personal account, I had 5 trades on, and all 5 of them closed above the call strike. So obviously very pleased with that performance. Now looking at the actual trade performance versus the S&P 500 going back to inception in February of 2024, we're currently at 83%, just over 83% now, and with the S&P at 31.61. So continue to do very strong compared to the S&P. And you can see the other metrics here. I track all these other strategies, just a covered call only, or the covered call with a put credit spread, but I like to focus on the one that I'm actually trading in a personal account. So here's our stock only versus the S&P 500. And, I keep stressing how I want to compare myself to the S&P 500 because that's our benchmark. But since the time we started tracking this, which would have been for stocks or trades that we opened in April and closed, there was 2 weeks in May, and then it's been, every week since then. But we've had literally just 1 week where the S&P outperformed our watch list. I do offer 2 different, very different newsletters to subscribers. If you buy one, you get the other one for free. So one price gets you both newsletters. Of course, this whole video has been over the bull strangle strategy, which is the stock and option strategy, but I also have a commodity futures newsletter, which specializes in seasonal spreads. You can get both newsletters for the low monthly price of $49, and I offer deep discounts for 3 months, 6 months, and annual subscriptions. The annual subscription actually is a 35% discount. And for a limited time, you can get your first month for just $1. So you can try before you buy.